PowerPoint 14 is about the conversion cycle, and as I said earlier in the semester, it's one of the three major cycles which we have. And for our SUA packet, though, we didn't have any examples of it. So this is going to include some documents and some discussion of what we typically see in a conversion cycle and why we would have a conversion cycle. The businesses you might think of, some of them you may think of and some of them you might not have thought of, that have dominant conversion cycles: CPA firms, law firms. And a conversion cycle is the cycle in which costs are accumulated with items that will be later sold. In the introduction, I discussed the fact that you really don't have enterprises that are only conversion or only merchandising, that when you have conversion cycle, the end result is you're going to be selling either your services or a product. With CPA firms and with law firms, they're selling their services and they're accumulating those costs that are associated with those services so that at the end they have an idea of what this particular job cost us to do. Now, within conversion cycles, you have job costing and you have process costing. A CPA firm is very individualized what they do. They will be preparing a CPA, perhaps taxes for someone, and if they prepare taxes for one individual, it's not going to be the same as preparing taxes for someone else. So their billing may be based upon the hours they put in it, or it may be based upon the tax forms that are required or the complexity of the work. It will all be different, and so the costs will also accumulate that way. You'd expect there to be a common spread between costs and revenue for each thing they do, for each job they do. So when they accumulate the cost before they go into a job, they're going to think about how many hours of labor it's going to take, what other costs they might have, and have an idea for that. And then when they go out and price it, there's going to be a difference. There's going to also, of course, be overhead in it, but you also need to be making a profit. You're talking about law offices, which is listed toward the bottom here. You're also talking about accumulating costs for that, and the service is providing legal services. Typically, this is done by the hour. So the charges might be based upon hours worked there. There's also incidentals associated with that, such as photocopying, clerical work, driving expenses, various other things going into those billings. So CPA firms, law offices, common professionals that use a conversion cycle. Mechanics. Now, if you were to go and have your automobile repaired, you would go and there would be probably some direct materials which would be used, and so the direct materials would be added to the job, and then there would be labor associated with it. And another interesting facet about mechanics, while we're talking about process costing versus job costing, is it's probably going to be a job costing situation. That is to say, everyone coming in and having their automobile repaired will have different needs. So the different needs will create the job costing system. Manufacturing plants typically are process costing, where you're accumulating costs and you're trying to put these costs through in a production line, and you have batches of output being produced with accumulated costs. Should be noting here that you have a common account which you see with this is called work in process, or sometimes called work in progress, which means we're accumulating our costs and we aren't done with our jobs yet. A mechanic can have work in process going from one time period to another, or actually if they were to stop work in the middle of the day, those jobs that weren't completed would have work in process. CPA firms are going to have work in process until the tax return is actually filed and the customer is billed. It's a work in process. Law office, until you're done with the lawyer and you've completed your case, has been settled, or whatever issues you have been completed, maybe documents are getting created, you have work in process. Now, cabinet makers, what can we say about cabinet makers? Typically, this is going to be someone who's going to do a job which is going to be very specific. So it's probably going to be under the job costing. You'll have different raw materials. Maybe it's mahogany, maybe it's pine, maybe it's a large kitchen that's being done, maybe it's a commercial kitchen that's being done. Construction firms. Construction firms are interesting because here you have construction in process, and you probably covered this about how to handle long-term construction projects when you took Intermediate Accounting 1. So that they have some typical AIS systems, but they also have some specific systems involved there. One business you might not have thought of is restaurants, and thinking of restaurants as having a conversion cycle. Now for restaurants, your work in process is very quick. I mean, going through the cycle from being a raw material to being a finished good, which would be like the pizza that's delivered to you when you go to Pizza Hut, it's very short. So therefore, you don't really have the work in process accounts that stay on your books for very long. Technically, it's like minutes, right? But you have the accumulation of the costs. You also have raw materials, and you're using the raw materials. And instead of applying those costs, though, to a process, what you're probably doing is taking a little bit by little bit these costs and applying it to particular jobs that are being produced. And you're billing. And how do you bill? You bill when you give the ticket to the customer, and the billing is standard because you're going to think of it as using a standard amount of tomato paste on the pizza, standard amount of dough, standard amount of ingredients, and it might be based upon size. So if you go to Pizza Hut, you look at their menu, you can see thin's going to be different than hand tossed or than thick, and you're going to see that pasta is going to have a different price. It's because they have thought through all the costs associated with these products and these, or if you want to call it services that are being provided to you, and they have considered all of that, and they're accumulating the costs into the products which they're providing you, in this case pizza, pasta, whatever. But this is a conversion cycle, so you need to start thinking about those as being conversion cycle, and mainly it's because you're creating. So in anything in which you create or make something that didn't exist before, it's conversion. And that's really what makes the restaurant's conversion cycle. So typically in the conversion cycle, you have materials which are being used, and we talk about these as direct materials, and we talk about raw materials as something in a crude form that gets converted. We have labor, we have direct labor, we have indirect labor, which is a part of the overhead. And all these costs get combined into our inventory accounts, and then when the product or services is provided or sold, it becomes a cost associated with that, and then it shows up as an expense. So in your classes previously, you had the discussion of being a period cost versus product cost, and I'm not going to get into that. We're in AIS, so in AIS we need to start thinking about how your AIS system would have to keep track of all of this. And so you need to be able to track the cost per your units produced. And if you're having a job costing system, then you're thinking of it in terms of your customers that are being serviced or provided for. But if you're having a large operating plant, you're talking about the units that are produced that are very much the same, but you're talking about what is the cost per one unit which is produced. There is the scheduling that has to be done in working through this, whether you're working with a restaurant or whether you're working with a manufacturing plant. You're talking about scheduling, how what are the needs, and you're basically gearing up for providing finished goods or finished services to the customer. So you're thinking about, what do I need in terms of logistics to get everything in place so that I can produce and provide. When there are different processes involved, you're going to have to report on the units that are transferred. This is typically what happens when we're talking about process costing and stages of production. Now, whether you're using a job ticket or whether you're not using a job ticket and using processing, you need to have an idea of the usage of your materials, and this is efficiency, and you need to think about how effective you are in terms of the units that are produced by the units that you put in. You need to think about the costs of each unit that's being produced and whether your costs are staying the same, going up, going down, because it all goes back to price times quantity. That is the quantity that's going in for inputs and the price of the things that are going into inputs. So you're tracking those. In managerial accounting, we talked about this in managerial accounting, and it was called standard costing. And so your AIS system has to keep track of standard costing. That is also in effect when you're talking about Pizza Hut, right? When you're talking about Pizza Hut. Because if you deviate from the standards, and remember your menu prices are based upon standards, then you're either making more or you're making less in terms of your profits. So two types of goods and services can be produced, and your AIS system has to adjust to these. If they are very similar or identically produced goods or services, you will use process costing. And this typically talks about a long run or those produced over a longer period of time. If you have something that's very specific to the needs of the customer, and our example here was legal firms and CPA firms, or cabinet makers for that matter, you're going to be using job costing. And so it really depends upon what is being produced or what is being provided, and as I like to say, created, because it's a creation process. Here is the technical definition of these then. Process costing, when a single product is done, typically on a continuing basis. Typically I also say over a long period of time. Doesn't have to be a long period of time. The point here we're making is that we are going to produce quantities that are very similar. Job costing, on the other hand, is used when you have a lot of different things being produced, and that because they're different, you're going to have different production requirements that are going into the producing of the product. And as I said, with a cabinet, you might think of it as pine versus mahogany. Process will then accumulate the cost in departments, and you could say this is also stages of production. Job order costing then will be by the customer. So you're thinking about the customer and you're accumulating the cost for a particular job that's being produced for that particular customer. Process costing systems then are going to have to compute the costs by each stage, and the stages then will accumulate it. If you took managerial accounting, you know there's a lot of different ways to handle this, but you need to have an AIS system that's going to be able to compute cost, accumulate costs, and was mentioned previously, we need to be sure that our costs are in line with what we had anticipated, whether it's process costing or job costing. So, as an example, in your AIS system, if you use job order costing, you would have job 1, which would have a certain amount of direct labor, a certain amount of direct materials. Now, your operations, your direct labor, it's possible the direct labor cost per hour could be the same no matter what is being provided. I'll give you an example here then. If you are having an auto repair shop, maybe the direct labor charges would be based upon the hours, not the mechanic. But you could also apply it based on the mechanic. A certain mechanics has to be paid higher wages, therefore when you charge direct labor, you're going to have a higher labor cost per hour for that mechanic's work. The point being is you're going to accumulate the labor hours by mechanic if you need to, and you're going to apply them to the jobs that that particular mechanic is working on. You're going to have different direct materials used because I could come in and I could need my brakes repaired. You could come in and you could need your transmission repaired. Those would have different direct materials being used. So each one of us going in, you could be job one, I could be job two, would have different costs associated. And this is what you typically see when you have job order costing. A job order cost sheet then is prepared, and this is done electronically now. It's prepared for most businesses electronically. They will have a computer system that will track how much time the mechanics, which mechanics are working on it. It will track your direct labor for your particular job. It will have your direct materials. That would be the types of the items from inventory, or maybe the items that need to be ordered to repair your car. It'll have manufacturing overhead, which is usually applied based upon some relationship to direct labor. You had that in managerial accounting. But the other thing you need to take into account when you're doing this is you need to mark up from this cost sheet or there will be no profit. So when you're billing the customer, this is the starting base for your billing. It's not the final bill, because if your unit product cost is equal to your revenue, you have no profit. However, what I said previously applies. Whatever the bill, the final bill is, will be related to this cost sheet where the costs are accumulated. Frequently, this is done with software. In previous times, it was not done with software, and you would have this paper document. I suppose if we did the conversion cycle within an SUA packet, they would have you filling out job cost sheets. Process costing is a bit different because here you have not jobs, not particular individuals being serviced, but you have processes being applied or stages of production or activity. My example on this is, let's say that you are making Coca-Cola or Pepsi-Cola. You have the direct materials, maybe it's a syrup, maybe it's a carbonation, maybe it's other chemicals, and they'll be applied at different stages of the process. You'll have labor, you'll have employees that are working when they are combining to make the product. You'll have the product being bottled or put into bottles. Maybe that's a separate process. And then you'll have a process where you are packaging or putting the caps on the bottles, or maybe it's cans and you are sealing the cans. So you have direct materials, you have direct labor applied to each one of these stages of production, and then you also have manufacturing overhead. The product is flowing through, and as the product is flowing through and being produced, you're also going to have costs flowing through. So the flow of goods is tracked through the costs, and you don't use job tickets to talk about applying these things to a particular job. You're applying it to everything. So over the right, I know you can't completely read in the blue box. It says, charge direct material and direct labor costs to each process, activity, or a stage of production as the work is performed. And then when you talk about a unit cost, you're going to talk about the units that are are actually created when you get to the last step, which is your last process in Department 3. You're still allocating costs to units, by the way, except you're allocating it to probably a large batch which is being produced. The AIS implications for us here are that in job costing, your AIS system is going to have job sheets, and it has to have the ability to input, say, labor hours, and it's going to have the ability to perhaps link into your raw materials if you are maintaining, say, you're a mechanic and you're maintaining a supply of raw materials. You would want it to link into that inventory so it would show goods being transferred from raw materials and applied to work in process inventory. With process costing, you're going to have many inventory level accounts. That's going to have your raw materials. You're going to have different phases of work in process related to the process or stages. You're also going to have finished goods. And then you're going to have the ability then to transfer all those costs and to track the costs as they go through the process. Completed projects in either one of these go to finished goods. And then the sold products, which will happen in this cycle or at the end of the cycle, I guess you're going into the revenue cycle, will need to trigger cost of goods sold. Whether it's job costing or process costing, it's going to have to trigger the cost of goods sold, and there is a link there into the revenue cycle. So those are some of the AIS implications that exist when we start talking about the conversion cycle. The logistics of this, there's also, you need to think about it from a managerial accounting standpoint and from management, that is to say, of the whole organization. We have to determine which products we should produce, when we should produce them, how many we should produce, and so our costs and that's part of engineering here. It's also a part of budgeting, where we have variances explained. All of this, and then R&D, including marketing. You might have some links to demographics. You might have some links to trying to really understand what characteristics you want in the products that are produced. So planning. You're going to be assisting with the planning. The resource management. If you have machines, how are the machines being used? How are your employees being used? And I mentioned the mechanics, that some mechanics would have higher skills than others, and how you allocate or use those particular resources. Do we need to hire more skilled laborers in particular areas? Inventory control includes the usage, the routing, reordering. If you are going to be producing, many people produce now just in time, you're really going to have to pay attention into your inventory needs and when you are going to need those and how quickly your inventory needs are going to be supplied. Operations, that is the production or the manufacturing itself, that is a very big area, because the accounting is going to support that, and accounting is going to guide operations. Are we using too much of our resources? Are we not using enough of the resources that we expected to use? Or maybe we're spending too much for those resources. Is there too much waste? There's a lot of issues there with operations. The AIS system has to be supportive of that. If I were to create a flow chart here, and this was provided in another textbook, but if we created a flow chart and we talked about the different stages or the different work which was being done, and we tried to create our swim lanes, we would see that there's a planning and a resource management side of it. There is a production side of it. There's quality control, which goes in to say, does it meet the standards? Does it not meet the standards? There's a link to inventory, and there's a link to the general ledger. In this particular one, we have job time tickets being applied. We have inventory status reports. This is in production, so I said it's very much linked to production. Quality control, probably you would think of that as engineering. You're thinking about the inventory, and this is the goods that are being produced. And then there is, of course, our general ledger and accounting that's taking care of things. Resource management, as you look over here in planning, we have here a sales order that comes in, and we have to figure out, do we have resources available? If we don't have resources available, we prepare that purchase requisition, and that gets you into that expenditure cycle, doesn't it? And accounts payable. Over here, when we talk about selling and getting to the end, when you start to sell your products, you're going to get into revenue. So none of the cycles really stand by themselves. They are all linked together. So you need to start thinking also about the cycles and how the cycles are linked together. Internal controls here, the production, requisition of resource, transfer of inventories, authorizations are required in many of these steps. Segregation of duties, that's CAR, right? Custody, authorization, record keeping, or ARC if you want to say it that way. You have inventory, you have production, you have finished goods, you have payroll, and anytime you're talking about the custody or the authorization or the record keeping within each one of the processes, you need to start keeping all those separate. We have to have a lot of documents. Now, again, early in the semester, we said documents don't have to be paper documents. But when we saw that job cost ticket or job cost sheet, you need to recognize it does not have to exist as a paper document, but it needs to exist somewhere because we have to accumulate the costs. If we're having process costing, then we also need to accumulate the cost, and we have to have a way to transfer it from one place to the other. Engineering, quality control, we have budgeting, we have all sorts of needs, and with this we have to have adequate records and documents so that we can perform those processes. There's physical control over the access and use of inventories. And remember, let's not just think about raw materials. Let's think about work in process. There's a very old song by Johnny Cash, and he was working in a plant, and he, it's a story, not Johnny Cash working the plant, but his song about an individual working in a plant, and he's manufacturing automobiles. Unfortunately, it's a different automobile that's being manufactured every year, and he's taking a part home whenever he can, and he's thinking, I'm going to take that part home, and I'm going to use that part, and I'm going to make an automobile. And of course, at the end of the story, he has an automobile that's comprised of many different automobiles, really. But the point of my story here is that you have to have some control over work in process, because individuals working can commit fraud. They can take things with them. It doesn't have to be a finished good. Insurance is helpful. Also, you're thinking about your employees as they are working and protecting those employees on the job. Limited access to the materials, again, is going to provide for greater security. So he shouldn't have been, Johnny Cash in his song, that individual shouldn't have been able to carry something home as large as an engine to an automobile, should he? So we're talking about controls, and we've talked about this before, and accessing plants and using some biological type scanning devices perhaps, or name badges to go in and out, and perhaps different levels to go in and out of a plant. Independent checks and verifications, this comes about because if you're using standard costing and you notice some numbers are just crazy, I mean the costs are just out of control, and that's the variance evaluations. When you look at those and you see that there's some things that are just doesn't make any sense at all, it's a cue to you that you need to check into it. You need to find out what is really happening. Is something being recorded improperly? Maybe someone is counting wrong when they're talking about the inventory of direct materials that's being applied. Maybe overhead is being misapplied. There are lots of things that can happen, and the variance reports will give you an idea that something is amiss. There's going to be some checks on the quality and the quantity as the goods are produced, and as they are being transferred within the processes, or as the job tickets are being computed. Someone will look at it and say, does it make sense that this is the cost for that raw material that's applied to the job costing ticket? So in all of our cycle, we always have these internal control activities. So by now you should have just memorized. There's authorization, segregation of duties, having documents, security of those documents, and security of the assets, and that you have independent checks and verifications going on within the cycle.